Hello, this is Silvia Pavoni, investment editor of The Banker, and I'm talking to Rick Waugh, who is the CEO of Scotiabank and also the vice chairman of the Institute of International Finance. Rick, we've just heard you talking here at the press briefing of the IAF just a few minutes ago, and many interesting topics have been discussed. One of them was the link between introducing capital controls in many of the countries, or in few at least of the countries in Latin America, and how this could help in containing excessive credit growth domestically. Would you like to elaborate further on this point?
Well, as was discussed and by Phil, our chief economist, and we've certainly seen it for many, many years in the countries, capital controls really don't work. It comes back to bite you. And it can be very tempting for policymakers to do that. And in a maybe short period of time, if they put them on and take them off right away, that may mitigate a bit. But they're very, they don't work, and the serious implications of them not working can be very significant. So that is an issue. So again, it's sound fiscal policies and what have you. Now we're seeing from a very practical event that there is that's good. There's lots of capital inflows, but it is creating a lot of liquidity, and therefore even on a banking sense, people start with all the liquidity. The bankers and that start to get more and more aggressive. And so I think we certainly in our bank and certainly a lot of other local banks try to stem the tide, but with all the liquidity, it's a problem, and that's where some balanced regulation or just some oversight just to make sure that the local banks are not getting too aggressive on credit underwriting, and that is probably a little bit better than instituting broad, dramatic capital controls, which would have huge, more greater impact.
Everybody's looking at Brazil right now, talking about the creation of a potential credit bubble. What are your views? Is there a bubble in the making there in the country, or are these worries unjustified?
Well, I haven't been to Brazil most recently here, but I have been to some other countries, and so on the countries I have gone, and you've seen a lot of development, you don't see the credit bubble aspects yet. We don't see it in delinquencies or problems in our loan portfolio. You look at prices, say, on real estate, on square footages and that, and they seem to be both on a country, regional, and international basis still reasonable. So I think it's a little early to say that, yes, we see it. I think we all should be concerned about it, but I don't see it right now on the horizon, and so we can remain relatively optimistic this, but we got to watch it.
Last time we carried out an interview the two of us was in Felleban in November 2009, and at the time Canadian banks were looked upon as a model to inspire the whole world of banking. Now new international rules have been developed and implemented on banks, and I was wondering whether that admiration towards Canadian banks is also translated into hearing what Canadian banks have to say about creating these rules and making sure that these rules are right for all the markets around the world, not just the jurisdictions where the problems came from.
Well, it's a very important point, and since we met in 2009, 2010 has been very good for us. We had a record year, and that was contributed by not only our Canadian operations, but our operations around the world in Latin America, Asia, and our wholesale banking. So that is good, and we just announced our first quarter, and again, it's record. So in one way, you would say, well, times are good. We have very strong capital. We got through the crisis without having to raise any capital, and of course, we didn't have any subsidizations. But of course, a lot of other jurisdictions did have problems, and rightly so. The G20 policymakers and the regulators got together, and we now have Basel III, and we also have the financial standard boards implementing. But a word of caution: Basel II did not work. And in fact, many parts of Basel II contributed to the problems of the last 3 or 4 years. Basel III is another model, and these are only models. Models are important, but they're only tools. It's how you handle the tool. And now the Model 3, in Basel III rather, seems becoming very, very prescriptive to solve some of the problems in some of the jurisdictions and countries or banks that did have serious problems. So we've got to watch that one size doesn't fit all. More capital, that's fine, but and I think we all recognize that, and liquidity and funding, but it's very prescriptive of rules, redefinitions of capital, when really it's risk management. Good capital levels and how you manage risk is very, very important. No rules or regulations by every regulator has ever saved a bank. Bad management will, no matter what the rules are, will see a bank. Good management, will always, hopefully, and I think does, do that. So the success, quite frankly, of the Canadian banking system was good, prudent, principles of regulation, and conservative capital ratios, and then it was the risk management and the governance of many of the managements of the banks, and Scotiabank, I'll make the plug, over there. That's so very important. So you have to find the balance between good, prudent regulation and good risk management, and be very careful of prescribed rules on a model hasn't proven itself, and in fact has indications that this type of model has failed in the past.
Thank you very much for your comments.
Thank you very much. Okay.